Welcome to the Media Capital Show. I'm your host, Diana Florescu. Join me and some of the greatest media capital investors and startup founders as we dive into what happens in the media for equity space, why it matters now, and how you can keep up. Media Capital is a media for growth production, a media for equity advisory firm, and global network of investors specialized in media capital fundraising. Make sure you subscribe to the Media for Growth newsletter to get all the insights from our latest episodes. Thank you for listening.
The number one most important aspect of deal structuring with a startup is to make sure it's the right kind of media. I was a little bit wrong. It was only half the answer. It's actually the right kind of media at the right price point. So our job as a media for equity investor is to find, let's say, a balanced price point. So we have to make sure that the media that we're making available to the startup is equally or more attractive, actually more attractive, to be honest, so cheaper in a way, than if the startup were to go out and buy it on a cash basis.
How did both of you make your way into media for equity space? And maybe Niko, we can start with you.
Yeah, so my own background is I worked for several years as a partner in a consulting and systems integration company responsible for the media industry in Europe of this company. So I had many years of media industry experience. But previous to that, I worked for a US venture capital fund, which is today known as Upfront. And I was part of the European team and had the honor to open their Munich office, which was a huge learning experience in terms of understanding about venture capital. So then when I co-founded the fund 10 years ago together with Aljoscha, I combined this media experience together with the venture capital experience.
There's so much that we're going to talk about. Sorry, I'm just going to let Aljoscha as well introduce himself.
Hey, so Aljoscha, my story is a little bit easier actually. The way I got into this is it's actually Niko. I was actually working in for a university, building an innovation incubator for them, and previously to that, I'd been working for a professional angel investor in their holding company. And previous to that, I worked in management consulting and sort of combining all this with a project that Niko and I had together, actually the book, Niko, that you worked on, I think around 2008. We were both really young then. And I was involved in this book as a supporter. And when Niko approached me with this little bit crazy idea back then, let's do media for equity. I said, what's media for equity? And he explained it to me, and luckily I got it, and we got going. So that's actually what brought me into media for equity was Niko, and of course the background and venture capital and the love for entrepreneurship and startups.
Great. And I love that because I think because it's such an interesting space and this session is also quite niche, as we just established earlier, that it's mainly a lot of emerging fund managers that come from so many different backgrounds. Either they worked in media like Niko, or they have a venture capital background and they just want to get started. So basically, I don't think it's a very sort of clear, natural projection into how you get into a media for equity space. And that's why I think your backgrounds are particularly very interesting. And the fund itself. So the next question I have for you, because what we're discussing today is obviously the thought and the thinking process behind German Media Pool and how someone came up with an independent fund model. So for anyone that is listening right now, just to provide a bit of context into the conversation, how does an independent media for equity fund operate? And how is it different from, for example, what you helped set up with ITV, Niko?
So there are two ways to offer media to equity to startups. One is that you are a media group and you offer your own media, which is your media, whether this is television, out of home, whatever it is, to startups in an investment model. So that's the media-owned media for equity fund. And then what we do is a little bit different and probably a little bit closer to a classical venture capital fund, which is we are not owned by any media group. We're owned by ourselves and a couple of shareholders who supported us at the beginning with some angel investments. And our media partners have framework agreements with us to supply us with their media. And on the other side, we invest in startups. So we're kind of like a fund, and the media partners are our LPs, except they provide us with media and not with cash. So that's the independent model. And both of those models coexist in various markets. The innovators who invented the media for equity model are aggregate media in Sweden. They were the first ones that I know of that did this, and we did it just a couple of years later for Germany.
I agree with Niko. There's in the structure and in the ideas behind the fund, there's many similarities to a regular cash fund, a classical cash fund. And I'm sure over the course of the next 45, 50 minutes, we'll be getting this as a recurring theme, because I think it makes sense to always talk about the similarities and the differences. And actually looking at the two different models that you just described, Niko, the independent fund model and the, how do we call it, the media company fund model. Model, thank you. It's actually quite interesting, just to add to this. So we actually have, at German Media Pool, we started with 3 media groups that quickly went or expanded to 4, 5, 6, and then I think by year 3 we were at around 20, and today we have anywhere, how you count it, somewhere between 40 and 80 different media partners that we work with in Germany and several European markets. And actually, of course, all of them are an LP in a independent fund, but interestingly enough, I would say 10 to 20, more like 20% of them have their own media for equity activities that they do independently of us, so as a media-backed model. So there's actually a link between the two. And I think it makes sense that a media investor actually gets involved in an independent fund like ours, where they have maybe a larger reach, also the ability to be part of a cross-media deal. And at the same time, when it's more strategic and maybe a topic that really fits with their media or their strategic goals, then they do it themselves, or even in a mix. Sometimes they invest into the same companies as a media-backed model that we've invested into as an independent fund model.
This is great. What you just said, I'm going to revert back to that example of some of your partners, LPs, basically doing their own investments. I think it's a really interesting aspect you just touched on. But just before then, so you are essentially the first ones to do this in Germany and one of the first in Europe as an aggregated type of fund, so an independent fund. And as you said, you've started with 3, you're now probably more to 30 partners in your fund, and surely it wasn't easy to manage so many different partners, and the way you structured the deals as well, which we'll go into that later. And we're talking about almost $250,000,000, I think, billion, euro invested in startups in the last 11 years. So my question to both of you, why do you think these media partners have actually, decided to invest their assets with you? And how do you go about discussing this with a potential partner? What's basically the value, the upside for them?
I think we have to differentiate between the first 3 partners that I mentioned, so 2011, and the actual, let's say, today's answer to your question. So the first, but not completely different. So in all cases, a media, let's call them a media LP, right? A limited partner in our media fund. So a media LP is essentially looking for the same thing in an independent fund as an LP in a cash fund. They're looking for track record. They're looking for alignment of interest. They're looking for an invest strategy that matches their own invest strategy. They're looking for a team that they trust and believe in. So it's not just the hard facts and the track record, but also, how well do you work together? But they're also looking for a few other things that maybe an LP in a cash fund wouldn't be looking for, such as, let's call it sales ability, right? I think in a media for equity fund, for sure, you need to be more sales oriented, because you're actually, if you're trying to invest €1 or $1 or a pound, it's a $1 or a pound or a euro. If you're trying to put media into a company, invest media into a company, make it available, there's a whole number of criteria that need to match. We'll get to that later again when we're talking about restructuring a deal. But you also need to make the media. You need to sell it. You don't need to push it on somebody. That's the last thing you should do. You need to sell it. You need to get the investment target to understand that this is something that makes sense for them. And so this is something that a media LP looks for as well in the fund management, I believe. And of course, as I said at the very beginning, there's a little bit of a differentiation between the very beginning, I guess, as always would be in the beginning. So the first LPs, the first media partners we had, were looking for all this, but they were also looking for something cool and something innovative, something new. they were themselves, I think, ready to try out new things, and maybe we came at the right time or at the wrong time, and we convinced them. Either way, the first media partners, we had to get them to believe in us as a person, not so much in the track record, because as you said before, we were the second media fund in Europe, and actually the first, as it turns out, that structured it this close to how a cash fund is structured. And it took a little bit of time to get the first 3 involved, and then took a little bit more time to get that up to 30, 40 partners that we have today.
Yeah.
All partners' value is the fact that they are combined with other compatible media types.
Absolutely.
So they instantly recognize. So from our first fund, where we only had 3 partners, crazy to think back to that time, we had 1 television partner, 1 radio partner, and 1 out-of-home partner. And they were really excited by the fact to say, hey, now you guys can actually combine different media types, provide those to startups. So there's actually more value than us just doing it by ourselves. And I think that's still the case today. So we speak to our startups, we try to understand what's the perfect media mix for them. And we can provide them just that tailored mix of all these different media types, which is obviously really, really cool and makes us get up, in the morning.
I mean, you're right. So half of your investments essentially have a mix of multiple channels. TV, I think TV and radio are the most popular as far as I recall, but you also have TV and outdoor. But when we go back to when you established the fund, I mean, surely you didn't have all the startups in the portfolio of companies you have today. You didn't know about who you're going to invest in at the start. So how did you go about structuring that LP composition and even thinking about the fund size back then?
Yeah, I mean, it's quite interesting. It's very hard to speak to partners that are supposed to provide a significant part of their business into a partnership without being very specific. And so actually what we had is we had a illustrative investment case, which we actually thought was going to work out. So we were in discussions with a startup. It made a huge amount of sense. It was consumer focused. It was a startup that was helping people refurbish used mobile phones and other tech devices. So it was like a consumer play, which is very mainstream. And so we were speaking to the founder, and the founder was like, yeah, I could see this. I could see this work. And the media partners, we used that as an actual case. It's like, this is what we're going to do. The interesting thing is that once we had these 3 partners lined up, they didn't use media for equity as their growth strategy. And that illustrative case actually never worked out. So our first investment was a completely different investment. But it was really important to be very, very, you have to have things that people can touch and understand. It can't be this theoretical. We're theoretically very complex what we do, so there has to be like a real case.
Yes, and we talked about this before, Niko, because I think, and maybe we can actually discuss structuring a media for equity deal, especially from your fund perspective, because it's not easy, mainly because you don't necessarily own the assets. Every conversation is different, and the way even you go about understanding what a startup needs, also back to what Aljoscha said about your fund skills and the people you have in the fund is quite different from a traditional venture capital fund. You actually employ a media manager to discuss all these intricacies, if you like, about the campaign. So if we go through a practical investment example of structuring such deal, I guess as with any other investment, there's a due diligence that happens. But I want to maybe go through some very basic yet fundamental questions that I'm sure a lot of the founders, but also fund managers are probably thinking right now. At what stage in the process do you discuss the media value that the startup will receive?
Happy to answer this. I do want to, really happy to answer it. I do want to come back a little bit still to the what are media publishers looking for in the fund, or rather, how did we structure the fund? Because it plays into your question, namely the question of how do you structure a media for equity deal and when do we get to the media value? So how does the process work? So if you're okay with it, I'm going to loop back to that, but I'll get to your question as quickly as possible. So, but it does play in. I'm not just, it'll make sense in a second. So when we started the fund, we were really thinking like a venture capital fund structure. We organized, we brought all the media partners into the fund, under let's say a risk sharing concept. Every media partner gave a commitment. We invested media from each of the partners in different amounts, and the returns that were generated from the portfolio that was built were divided across all involved partners according to a certain key that had been defined previously.
Whether they provided media or not.
Whether they provided media or not, and also mostly independent of how much media they provided. And the idea behind this was, well, we bundle the media and we bundle the risk. And some of the startups will work, some won't, and so on. And so we really stayed very close to a venture capital fund structure. And actually, we did this for 2 years. It worked more or less well, a little bit less actually well than we thought. And so after a few years of this, we actually went back to the media partners and we completely revamped the structure. And it's actually the structure that we still have today. And in a minute, that'll tie back into your question of what kind of media are we providing, what are we looking for, and how do we structure the deals. So what we actually went from a regular fund structure, including a certain amount of time, a beginning and end to the fund, including pre-commitments that we could draw down on, including a decision process that was based on our own IC. So an IC that we formed within the fund, somewhat jointly with the media partners, but really more of a classical fund structure and risk sharing. We went from that to, let's call it individual funds within the fund. So we actually learned, and in hindsight, it's maybe quite evident, that, well, the media partners, they're at best in co-opetition on the market, if not competition to each other. And if you're in a fund structure where you're bundling risk, then there has to be transparency about what's being invested where and at what price point. And as everybody knows that listening, that media in many cases has there's varying discounts on the market to the list price, and after the discount is the amount that's is sold or that you can buy or invest. And these discounts became transparent in the risk sharing structure, and that's something that didn't really help for various reasons for our investment process or the investment amounts that we were making. So we completely ditched this. We went to this individual structure where we had individual media partners as part of the fund. We still have a cross-media fund. So let's say we have 5 different partners. We have 2 from TV, we have radio, and we have out of home. What we did is we said, okay, we'll invest, if they want it, we'll invest for each individual TV partner, and the media of theirs that's put into the startup, the returns from that investment will go directly back to that media partner. Or we can, so that's what happened with TV. Or we said we can also bundle individual media partners together. For example, our radio partners are bundled, that's called pooled, into somewhat of a risk-sharing construct, but then only for radio, where, well, transparency becomes less of an issue. And as a result of doing this, we had 3 things that actually happened, and I'll get to your question about the structuring. The first thing is, whereas before we had fairly limited amounts of pre-commitments and thus investment volume that we could make available to startups, because of this case-by-case structure that we went to, essentially, we have an individual decision. We have an individual return for each individual media partner. We coupled that with a case-by-case structure where they made individual decisions. I want to be part of the deal or not. They're basically an IC of 1 jointly with us, so an IC of 2, the media LP and the media manager. Because of that, the media partners kind of, let's say, went off the brakes. Whereas before we had, let's say, an invest volume, I'm making up a number. Let's say the invest volume before was 100. Suddenly the invest volume went to 1,000 that we could have with a media partner because they didn't have to pre-commit into something they didn't yet understand.
Right. Aljoscha, can I jump in with one small comment, then we come back to you?
Yeah, love to.
One of the hugest headaches we had with the initial structure, where you could literally, if we had lunch together, you could see our heads fume while we were eating pizza, was that given the first structure, we actually tried to balance out the amount of media from the different types into the different startups that we had. So it was super hard because we were like, oh dear, like let's say we would have invested less radio in the past 2 deals. We would be like, okay, where can we now invest radio so that we have a balance between radio, out of home, and television? And that was just not something that was in the interest of the startups. So we realized that the model was not in the interest of startups. We need to have a model that works for the startups. And this individualized case-by-case investing where, okay, for this startup, it makes sense to do a huge amount of TV and a huge amount of radio, but nothing else. We can now do that. And previously we were always trying to figure out how to balance out the different media types. That was just really, really bad, hard work and didn't work.
Yeah. And so this is usually the question that I get a lot of the times from emerging fund managers. And basically, if we were to so this is very, very useful and interesting. But if I were to just sum up the evolution of German Media Pool from where you started to now, initially you basically had pre-commitments from the media partners, and you were allocating the exit proceeds pretty much in an equal way, let's say, back to the partners. Whereas right now there's no pre-commitments. You approach every company on a case-by-case basis. Is it fair to assume, in terms of a legal structure, is that an SPV, or how do you actually sit on the cap table of the company? Is it through German Media Pool, I assume, right?
Exactly. So it's a very good summary. And I'll answer your question about which vehicle we use in a second, because what you just said is very true. So what happened as a result of this shift? One, we went to a case-by-case structure. Funny enough, the investment decision became much easier. Sometimes when someone doesn't have to pre-commit, it builds trust. And with that trust, we suddenly got into a structure that actually made it very efficient to invest and make the invest decision on a case-by-case basis with each partner. The second thing that happened is we essentially created an evergreen structure. We're still in the same fund cycle that we started then, and we've invested the amount that you just named, so significant amounts of each of our partners. And the third thing is it made it much easier for new partners to join. Obviously, they're in a setup where they can be involved in a deal, but they don't have to be involved. And the way that we structure this, getting back to your question, is unlike in a classical fund, our LPs are not actually shareholders in our holding entity, in German Media Pool GmbH, so the German holding entity. And because of this, it's a purely contractual relationship. And because of this, we can actually reflect this case-by-case evergreen structure for each partner within the same vehicle, and still have one single vehicle with which we invest into the startups. So it's always the same vehicle. Well, there's a second vehicle for one of the media types, which is print. But aside from that, these two vehicles, one has the bundling of everything but print, the other one with print. And they're the only two vehicles that invest into the startups. So it's not an SPV structure. It's a very classical structure.
It's almost like a syndicate fund. Sounds like it, right? You're kind of syndicating more or less every deal.
Yeah, within the same structure.
Yeah.
It's an interesting way to put it. Yeah. And sorry, one last sentence, most important one. I just realized this actually as you're doing your summary, and you, Niko, as well. One of the things that, maybe the most important thing in a way that also happened, is we truly became independent, because we didn't have an obligation anymore to invest media from each partner, because they were now in a case-by-case structure. We now, and as we expanded the amount of media and the types of media we had available, we had years where we didn't invest anything or almost anything from one partner, and the next year we invested a lot from them. But that was fine for them, because they were in this case-by-case structure where they could be part of the deal but didn't have to be. And now suddenly, for sure, we had a structure where we are able to tailor each deal to the needs of the startup, but can also turn down deals even if we haven't invested any TV for a year. Fine, we'll invest it next year. We don't have to look for startups.
And I guess that bundle you mentioned about doing it per channel, like you gave the reference of radio, it's no longer applicable. Obviously, you're only deploying assets that make perfect sense for the startup, and those exit proceeds will just be distributed accordingly to the investment in each case, in each startup, right?
Even where we bundle the media, such as with radio, for example, in Germany that makes sense, because in Germany you have radio stations state by state. No radio station, almost no radio station is national. Let's say like 2%, I'm making this up, 5% of the radio market is national, 95% is state oriented. So what we've done is we've bundled all the different state radio stations, from a radio station from each state into a pool. But even there, the proceeds are allocated based on provided media and not any kind of other distribution mechanism. So it's still there. It keeps us very independent of, which media partner from which state in radio do we include and which one don't we include. It's always based on what the company needs.
And I know I think there's been more than 38 investments today, but some of them do follow-on investments. So I think we talked about probably about 60 or 70 plus investment rounds.
Exactly.
In terms of
counted.
Right. Well, I count everything. Don't worry. We're going to go back to your exits if you want an IPOs as well. No, I'm just kidding. But in terms of in that case, then in a follow-on investment, then those exit proceeds then are allocated based on just on a traditional kind of waterfall structure. So whichever invested, closer to that latest round, or.
So the waterfall, I think when our media groups invest, that's always within one, let's say, investment, right? So if we have radio together with out-of-home with TV in a certain Series B, for example, then it's the Series B waterfall that counts over all of the different investors that are part of that Series B round. But then when we get to the distribution for Series B proceeds, there we don't make any distinction. It's just according to who put in which amounts of media, and then we distribute according to who put in which amounts of value. So there's no more waterfall within, let's say, that group. But interestingly, for several of our largest investments, we've invested for several years in a row in different venture rounds. So take an example about you. We invested in several rounds over several years. And so there we have to be particularly careful that obviously, the media groups that have been part of a certain Series A get that distribution, then media partners who've been a part of a Series B get that distribution and so forth. But we obviously track that, and it's very, very transparent to the partners what they get.
I mean, essentially we kind of started discussing more or less structuring a deal, but in a, in a natural sort of timeline, if you like, from stage to stage. But since we are discussing this particular example, essentially media for equity, it's a mixture of debt and equity investment, right? You're doing these investments as a convertible note or a safe note.
Correct. So I just realized that
I know they're very fundamental, basic questions. So I appreciate you're probably thinking like, where is she going with this? But trust me, actually, not a lot of people know about this.
Maybe the funny look on my face was I realized that 3 times I said I'm going to get back to how do you structure a media for equity deal, and I never did.
Don't worry.
Don't worry. We'll get to that. So one, to answer your question before I get to anything else, so I don't make the same mistake. We can invest based on our structure. We can invest both directly in a round, so meaning we sign for shares and make the media available afterwards. And of course, in a way, there's a promise that we will make the media available, and if not, we would have to give back the shares. It's never happened, but this has to be part of such a contract, such an investment contract, investment agreement. And the other mechanism, which you just described, you called it a convertible note or a safe. For various reasons, because it's a service, we can actually not technically invest with a convertible note or a safe, but the mechanism that we use is very similar. Basically, we make a promise, we sign a contract that promises to make a certain amount of media available within a certain amount of time at predefined terms, and the shareholders sign an agreement that promises us a certain number of shares, for example, in the next round. And it sounds like a convertible or a safe, it's just not called that.
That's different in different markets.
Sure.
Yes. And you
created
some markets.
Term sheet,
exactly.
I suppose.
Exactly.
Yeah.
And I do want to say something about this now because I promised it 3 times. So structuring a media for equity deal, do's and don'ts. I'm just going to mention one thing. I think the number one most important aspect of structuring a media for equity deal is to make absolutely sure that you're making the right media available, the right media mix in the right amount over the right time amount or time frame available to the targets. More than anything else, this is the number one aspect to the structuring of a media for equity deal. And that's something that we've worked on for many, many years now.
So great. So how going back to that point, Aljoscha, how do you ensure that? How do you discuss and how do you basically value that media capital that the startup will receive? And what I mean by this question as well. So this is one of the things that I'm kind of struggling with, because when you're discussing a deal with the startup founder, who ultimately is in charge of the fundraising process, getting the valuation right for the company, I'm sure, is in charge of the investors' governance, et cetera, it's a different ball game from discussing the same deal with a chief marketing officer, for example, right? Where I think their approach would be more coming from a commercial standpoint and looking at all the interesting things that I need to look at, like KPIs, targets, objectives, etc. So basically, they're treating this investment as their marketing budget. Now, how do you marry the two sides, especially when the founder is more concerned with the company valuation and giving, probably less equity, giving away less equity, whilst the CMO or the marketing officer has their own agenda about how they want to spend their marketing budgets?
Yeah, maybe get the discussion started. It's really crucial that both the CEO as well as the CMO understand or have the feeling that the media will work for them and will contribute to their growth. And there's basically only two ways this can happen. Either you've already done a little bit of media and you've tested it, so you've done a small TV test or a small out-of-home test, or you know that your category, let's say it's food additives, works very, very well with a certain media type, for example, television, because maybe even dozens or hundreds of brands before you have proven that there is traction with television with that category, and it's truly mainstream category. So that needs to be the foundation, because there needs to be just a strong understanding, okay, we want this company to have media. And then it's actually usually possible to get those two different views together. Both the CMO and the CEO understand that they can do more media through a media for equity deal than they can if they just simply take that cash from a VC and give that cash to an agency to spend. So there is there is a value advantage to doing a media for equity deal, because the media partners expect or hope that there will be a multiple in their investment, and they will get back more than they put in. So they're able to provide good media value.
Just a follow-on question on that. Have you received any pushbacks from existing investors sitting on the startup cap table when doing this investment?
Absolutely. Just like any new investor would receive pushback on joining an existing cap table.
And what are the kind of preconceptions about this? I mean, I'm asking because I know of many deals that haven't gotten through for the exact same reason.
So I think it comes back to your first question. They're very closely linked, that Niko was just answering. So as a media for equity manager, I just mentioned that I think the number one most important aspect of deal structuring with a startup is to make sure it's the right kind of media. I was a little bit wrong. It was only half the answer. It's actually the right kind of media at the right price point. So our job as a media for equity investor is to find, let's say, a balanced price point. So we have to make sure that the media that we're making available to the startup is equally or more attractive, actually more attractive, to be honest, so cheaper in a way than if the startup were to go out and buy it on a cash basis. So what we like to say is that a euro spent on media for equity is actually more valuable than a euro spent or a dollar spent on cash buying media. And the way that you do this is in addition to the media for equity model itself, we simply make sure that the media that we're making available to the startup is at the absolute best price point that they would be able to get on the market. And the best price point doesn't mean it's free. It doesn't mean it's 10% of the regular market rate, but for sure it means that we have to find a balanced price point that's both fair to the media owner, so meaning the actual value of the media is reflected, but it's also fair to the startup in the sense that it's more attractive than what they will be able to get otherwise. And if we do get pushback from the existing investors, it's for one of two reasons. One, it could be because they've never had a media for equity investor on board and they're worried that there's ulterior motives, strategic interests, and so on and so on. this doesn't really apply to us as an independent fund. So that's quite easy to explain. And the second one is always around price. Actually, there's a third one. I'll get to that. It's around price. And we simply have to make sure over and over again to show that the price point that we're making the media available, that we're investing it at, is extremely attractive and something they would not be able to get otherwise. The third thing we have to make sure of, vis-a-vis the CMO, the CEO, and the existing shareholders, is, let's call it deal size. So one of the other things we learned over the years is that what we like to say is small is beautiful. So we've actually learned that if we want to have a big deal, the best way to start a big media for equity deal is really small. You set up a deal with a goal, let's say we're trying to reach 10 million in media over the course of the whole deal. Then we don't do a 10 million investment, we do a 1 million investment with an option to scale that to 10 million over the next 1 to 2 years. And what we're achieving by doing this is we're reducing the risk that the startup CMO, CEO, and existing shareholders take on that would exist with a huge deal. They're committing to something very large, which may or may not work the way that they'd intended it to, or maybe even the business model pivots over, within 9 months or 12 months, as happens at some startups. And suddenly the media is not really as applicable anymore. So what we tried to do is we tried to emulate sort of the media strategy the startup would have if they were purchasing the media on a cash basis, but still making sure we have all the advantages in pricing and in partnering that we have from a media for equity deal.
And also one thing is really important, that at the beginning we had more resistance from VCs than we have today. So I think what we've been able to do is prove that the model is a sustainable model, that startups have used this who have ended up in very successful IPOs. So there's great lighthouse projects in the meantime, or lighthouse examples where media for equity has really worked. And this all has and we have co-investors that now, they know us. So maybe we've done 2 or 3 deals with a venture capital fund. Well, then they're not going to, have those questions again when we do the 3rd or 4th deal with them. So it's gotten a lot easier. A lot of VC funds have understood the value that media for equity can bring, especially if the media for equity partner makes sure to say, hey, it's only where actually the media makes sense. We would not want to do a media for equity deal where it actually will not work for the company. So.
We actually turn down a lot of startups let me put it another way. We actually talk a lot of companies out of doing media for equity for various reasons. Too early, not the right media type, just not ready for any kind of media, or will never be ready for media. It's a model that, they should stay online, for example. So we do, and I think it really builds credibility. We actually don't do a lot of deals where someone would like to look into media for equity for the main reasons.
And I promise we'll definitely go back to that subject, because I think this is probably a separate conversation, especially for any interested founders that have either raised or not raised media capital. I think there's so many different things to touch on, especially is this really the right type of funding for you, for your business, and depending on the stage you're at, how much funding you've raised, your business model, etc., etc. I think in terms of the ticket sizes and these investments, another interesting point, which I know, Niko, you're just about to say that earlier, that this model actually varies so much depending on the country and where you are and the different regulations. When does the actual media capital convert into equity? So if you were to do a 3 million deal, which you are structuring this in tranches over the next 3 years, does the media capital convert when you actually sign the term sheet, or is when the media gets deployed?
So it depends whether we invest as part of a round or as a convertible. But when we invest in part of a round, so there's always the first tranche of media is always mandatory. Otherwise, we wouldn't have a deal. So when we invest in part of a round, we usually have the share allocations for, let's say, tranche 1, tranche 2, tranche 3 already written into the investment contract. And then what happens is, and this is very specific from market to market, we actually get the shares either in the beginning or we get it when the media is actually provided. That really varies from country to country. But one thing that Aljoscha said is really important. If in any case we cannot provide the media, there's a clawback mechanism so that we return the shares for that piece of media. That's really important.
Right, and that equity so the media capital converting into equity, when you say depends on the market to market? Is that where the company is headquartered? Because obviously you are in Germany, but you do investments outside of Germany too.
I think it depends on the market and, let's say, the preference of the shareholders. So our preference in a way would always be to sign for the shares before delivering the media, because it's just simpler. You don't have to worry about getting you're just part of a regular round and an investment agreement that's being signed already. Often those shareholders, especially when it's a first-time deal, they've never gotten to know us before, or they've never done a media for equity deal. They prefer to have the equity convert at the end of when all the media has been delivered. And so it is a little bit dependent on the market, how common it is to have a convertible or a safe mechanism, or what are the investors looking to do in general. And then actually, there is an in-between to the two. So the first we described was signing up front. The second was signing after the fact, so after the media has been delivered. We have had some instances where we signed an invest agreement previously, and then the shares were issued but not transferred, so they were allocated to us as the media was being delivered. So let's say every 6 months, for example. But right. Again, that was a preference much more than any kind of structuring or legal requirement inherent to a market.
Right. And since we are diving deeper into this subject, I do have a question more to do with kind of the legalities of this. And I know Germany is particularly different from other markets, even like Switzerland. But how would a media partner essentially count the media assets that gets deployed as part of these deals? Is it a revenue? Is it in-kind media, like in a barter agreement? And what do we actually pay tax on? Is it actual revenue, or is it just the equity that gets booked as an asset? And I appreciate this. This is obviously your view from more of a kind of Germany-based fund point of view. It differs so much depending on the country we're looking at. So
I think it's up to the media partner to decide how they account for the media that they provide, for sure. So this is really something that the media partner have to decide for themselves. I think that most media partners out there, especially the ones that are investing directly their own media, actually account for the media that they provide in a given year in a deal as revenue, and pay their kind of corporate tax on that piece of revenue that they've contributed to the startup in that investment year. So they actually put it into their books as revenue. That's the most common model. There are other models that are more refined, where one books it as revenue later, for example, during the exit, but that has to be agreed with tax consultants, and that has to be decided by the media groups themselves. So that's a very tax-specific question, and you should really have very seasoned tax professionals work that out for you.
Yeah, and the reason, again, it might be probably, depending on who's listening in, I get a lot of inquiries and interest actually from emerging fund managers, but outside of Europe. So Brazil, Latin America, Southeast Asia. So I know, obviously, this is a very specific question to each market, but it is one of the questions that tends to come up a lot. I think when thinking about the fund formation, getting this right, it's a tricky one.
You always have to pay the tax, so it's about structuring it so that the timing of when you pay it is optimal for you.
Yeah.
Yeah, I agree.
So,
it's
yeah.
No, go ahead.
No, go ahead, Aljoscha.
It is something that each media partner needs to decide. Well, they decide it, but it's also it's stipulated by local regulations. So, for example, if you have a country that's mostly aligned on IFRS accounting rules, then there's far less ability to decide. So in a market with an IFRS-based tax or accounting regulation set, there, as far as I understand, because we don't have this in Germany, but as far as I understand, there you're always accounting for the delivered media on a fair value concept, and as a result of this, you are being taxed at your regular corporate rates as the media is being delivered. But on the flip side, once that tax has been paid, anything that you're making above and beyond the media that's been delivered, so your exit proceeds, will be considered as actual exit proceeds. So they will be taxed at a far lower rate than your revenues normally would be.
Taxed as an
in other markets,
yeah.
Sorry?
Taxed as an investment.
Taxed as an investment, excuse me, not as an as exit proceeds from an investment, very important. And in other markets such as Germany and I think Switzerland and a few others, that at least the ones I know, there's you can opt for either IFRS or what's called here in Germany at least HGB taxation. And under this tax regiment, you're actually able to defer the taxes to the point in time that there's any kind of exit proceeds. But by deferring this, the taxes happen later. At the same time, the taxes will be paid as regular revenue. So let's say investment proceeds would be taxed at, I make it up, 5%. Regular proceeds or income are taxed at 30%. Well, if you delay it, then you have everything, including the exit proceeds, the investment proceeds, later taxed at the 30%. So it's the flip side. You can opt to tax now and have lower taxes for the exit investment proceeds, or vice versa, you can opt for later, but then it's a higher tax rate on what you make later. And there's positive and negative aspects to this, and deciding on it and actually building a structure that allows you to do both is quite complex, as we can attest, and it's a little bit expensive. You need some really good tax advisors, but once you've got it set up, which we have, you're able to do quite a bit with this.
But I guess the media...
That was one of our hardest...
Yeah, that was one of the hardest, but also most interesting things
in
establishing a media for equity fund, is establishing the tax model. And we always say we worked this out with the tax consultant that wrote the book. So our tax consultant that works with us actually wrote a book about corporate taxation, which is one of the kind of one of the books that are in every tax office, like on the shelf. You know, this guy wrote that book, right? So he was actually the only reason we could persuade him to work with us at the beginning was because he thought this was such an interesting thing to do, to work out this model with us. It was like a personal challenge. And it's really exciting. I mean, we've really established a new type of investment model. And part of that is this taxation model that we use. So it's really, really, it's also part of our secret sauce, I would say.
Exactly. We don't have to go too much into this, but as you said, although sometimes it comes down to the corporate to decide how to do the taxation, they would look up to you as a fund manager, right, to advise. And I think getting this right or trying to suggest the best way possible, that's obviously something they expect. This is actually an interesting leeway into, I have a question about your team structure, because I think that's another just kind of interesting differentiation between a media for equity fund and more of a traditional venture capital fund. I mentioned at the beginning that you have a fund manager, a media manager in your fund that would work with the startups to try to, best structure these media campaigns. What kind of skill set, when you started, what sort of skill set were you looking at, and what does a fund need basically in their team to make it a success?
I think that in difference to a cash VC fund, every person in the company has to have both VC and media knowledge. So that's maybe the first statement, but then from there you actually differentiate. I think we have three types of roles generally in the company, in the fund. The first are the persons that are more investment focused. So the investment managers, the associates, and so on. And they need to first and foremost have VC skills and then learn the media skills. They don't have to have the media skills up front. We will teach them. But the VC skills, or rather the ability for venture capital, needs to be there. Of course, the ability for media as well, but that's something that they will learn as they join the team and grow within the company. Then we have the media roles within the company. And there, first and foremost, you need media knowledge and media skills. And then we teach them as they grow into the company, the VC side of things. And then the third, that one's quite easy and exactly the same as in a cash fund. Let's call it the back office function, finance, accounting, organization of everything that happens, actually the people that make the fund run. And there, of course, there's no difference between a cash fund and a media for equity fund. So that's what we look for. If we look for someone for the investment side of things, then we're looking for first and foremost VC knowledge or background, and then we teach the media side of things. And if we're looking for someone for the media team, and I'm calling it the media team, actually we're one team, but someone for the media side of the team, then we're looking for media first and then VC second.
Right. I think with the fact that German Media Pool is an independent fund, even more so, you should probably have a media manager in your team. But compared to a media-owned, a media-backed fund, do you see it absolutely important to work with an independent agency in terms of striking these deals and making sure that it is fully transparent?
So first and foremost, we're actually, it's obvious, but we're not an agency ourselves, a media agency. And we've actually always made sure not to become or be perceived as a media agency. We're a media investor, and we have a small media team, not to replace an agency function, but actually to take on, let's call it a project management and project steering function to make sure that the media campaigns go as best as they possibly can. They're like a liaison between the VC side, the investment side, and the media team at the startup / at the agency that the startup hires. And to answer your question, we actually don't partner with media agencies directly. We know many agencies, and sometimes we bring them deals where media for equity doesn't make sense, or they suggest deals to us where maybe the startup wants to do a combination of media for equity and classical media buying, or even only media for equity. So it's been quite cool. Whereas at first by agencies we were perceived as a competitor, I think in many cases now we do work together. We help each other, let's put it that way. And we actually think that we don't need to be associated with an agency, but rather we recommend to every one of our portfolio companies before doing the investment, or rather as part of the investment, to get an agency that will help them assess the media deal and actually implement the media deal in the best possible way, but also with independence in the consulting that the media agency provides. That being said, some of the companies, such as About You and a few of the other really late or later stage companies, they've actually simply built a media agency within the company. They built a team and acquired the knowledge and the skills and the tools actually that would be the same as what an agency would have provided to them. And this has been quite cool to see. Yeah. It's actually quite cool, just a little anecdote. It was cool to see how, for example, About You, when they were building their media team, initially one or two of our media partners helped them by making tools available and explaining how those tools worked. And then how the team from About You quickly turned around and actually went back and explained maybe to the media partners how some of those tools could be optimized and used in an even better and more efficient way.
Yeah, and I think What 3 Words is just another example as well. I know the team has great skills and capabilities in their house as well. I know I'm just looking at the time, and we already established at the beginning. I really enjoy this conversation with you. I know you have to run, Aljoscha, to another meeting. But before we wrap up, I do have a quick fire run of statements that I want to run by you. But I saw that Scott just left a question for us in comments. So he's basically, I know Scott. He's doing some great stuff, and he's a huge advocate of this model. But he's trying to approach media for equity from an influencer standpoint. So he thinks there is a great opportunity in terms of using influencer marketing and celebrities in terms of building this space. His question is, what do you think about adding new media sources such as influencer marketing to your fund? And I know some funds do that. They have some agencies in their portfolio.
I think some of the sharpest minds in the industry are right now thinking exactly like this, including Scott and
us.
Aljoscha is humble as usual, but no, I think this is something that we're thinking about a lot right now, and I think it makes a huge amount of sense. What we have to, we're kind of looking for the perfect way to set this up. So in other words, how much of the equity proceeds would the influencer get? How much do we work together with an influencer platform that has a, let's say, long tail of influencers or not? So all of these questions are super interesting, and we're in the middle of talking to different people about this approach right now. So I think it's something that makes a lot of sense because there's many similarities between premium above the line media and influencer media. There's a lot of similarities there.
Yeah.
In general,
I think
2 sentences really fast to answer to you directly, Scott. So one, yes, we're definitely, as Niko just said, thinking about influencer for equity, if you want to call it that. We're also looking at other media types such as online. There's areas of online advertising that in the past we'd avoided because we didn't see the fit with media for equity. We're actually looking into and working on this now. We're setting up partnerships for this. We're adding new media partners with online inventory. And we're looking at new media partners within existing categories, such as out of home, which traditionally had been purely offline and analog, and now is shifting to digital with whole new options and mechanisms that can be used and media types that can be used there. And so very much Scott and Diana and everyone out there, we are thinking about the next step for media for equity and the media mix that we can make available.
I think it's a very interesting space. I mean, we see the likes of this kind of rising new stars, if you like, Mr. Beast, for example, which it's a, media powerhouse. But then you also have more traditional
like a whole TV
media.
station.
Yeah, and also that, I mean, I think NBCU, if I'm not mistaken, they have their own kind of influencer marketing leg department, if you like. So they do that as well. I think from conversation I had with Scott, one of the things we were thinking of, it's when you add that into the mix, it's more about how you actually measure the results, how you run, your attribution models and so on, because it's not necessarily an easy one. Or I think there's a lot changing in the industry, but it's definitely not as easy, especially when you bundle that with different channels. But I promise that I'm going to be short and I have a couple of questions left. So just a quick fire round of statements, 30 seconds each. And you guys, you just tell me your opinions on this, all right? So maybe we can start with Niko. Best investment advice that you have received and what it stuck with you?
That I have received?
Yeah. And you can answer this from German Media Pool cash fund as well. I know we haven't touched on that, but obviously, you're running a fund as well, a cash fund. So you can answer from both perspectives.
Best investment advice I've received is that in the venture capital industry, reputation is the most important thing. So sometimes you have to make a tough decision that maybe is not in the financial interest of your own fund, but is in the overall interest of the different investors and the stakeholders in that investment. And you have to do it that way, because in the end, you're not just doing one investment, you're doing many investments, and you want to build a portfolio. And a portfolio can only be built with trust and a good reputation in the industry.
Great. Aljoscha?
It's really funny, Niko. You didn't steal my answer. And your answer was way better and better explained than mine. Mine was going to be, but mine was very similar in the following way that the best advice I've received is that, how do we put this in a good way? In German, we say you see each other more than once in life. And this is even more applicable in investing, that everything you do in an investment business is long-term. You invest today, you have proceeds in 3 years if it goes really well, and 10 years if it takes a really long time, or never, of course, can also happen. So that's long-term, but also the relationships that you build are built for the long term. The investments you make, how it's structured, everything is built for the long term. And when things are built for the long term, something like what Niko just says applies, but you need to really, you need to make sure that you build strong and fair relationships. So the advice that I got is treat your co-investors and treat the founders very fairly, and especially the founders. Nothing's more important than the founders.
Right. So being
not as
fair,
well answered as Niko, but it has a very similar twist to it.
It's very well answered, Aljoscha.
No. Thank you.
So Aljoscha, you mentioned, I love like the chemistry between the two of you. It's
like a married couple.
So,
we're working together for more than 10 years.
So what you said, Aljoscha, you started essentially, well, obviously you had your reasons, of course, but you started in the space also because of Niko. What was the single kind of biggest lesson you've learned from Niko in all these years?
So I often say that Aljoscha is the numbers guy. And I say that because numbers are the most important thing in an investment. And it's something that Aljoscha goes back to the fundamentals always and says, okay, let's look at the numbers one more time in a really rigorous way and try to be really objective about this. And I think this is such an important thing that in the end, we are a financial investment service or a financial investor, and it boils down to the numbers, always, always, always. And I'm a very impulsive guy that likes to, takes decisions by gut feelings. And Aljoscha draws me back into the objectivity zone. And that's probably, Aljoscha has contributed so much value to our fund. I can't begin to put it into numbers.
That's very
Thanks,
sweet.
Niko. So I think from Niko, I've learned two things. Let me rephrase. I've learned a lot of things from Niko, but I'm not going to say the one most important thing, the two most important things. So I've learned two things that are really, really important from Niko that I didn't have before. One of them I think I implement well. The other one I really work on implementing well, but Niko's better at it. So one, I learned, and there was a quote, Niko, that you had on this. I don't remember how the quote went exactly, but basically the gist of what I learned is often it makes more sense to work on or answer something quickly, maybe at a 90% level, than taking too much time and trying to get to 100% level. I'm the guy that tends to work, take too much time and try to get to 110%. Niko's the guy that does it quickly and gets to 90%. And there's a lot of efficiency and a lot of value in providing answers or working on something and completing it efficiently and quickly. So I learned that from Niko.
Is that actually a good thing, Aljoscha?
It's a very good thing.
Okay.
Absolutely.
I can relate to that. I can definitely relate to that.
And the other
I always
thing
say,
is,
if you respond quickly, then the person that you're responding to doesn't expect the well-founded 100% answer, but is grateful that they got an answer really quickly. Whereas if you wait longer, you really have to put back the 100%. So I don't know if that's really such.
Yeah, but there's also a lot of people out there that are waiting for my answer, and they could have used your answer much more quickly, and it would have helped them far more than my perfect answer, 2 weeks later. So, and I think, as you can tell, there's probably a balance between the two of us in that sense. We help each other, we complement each other. And the other thing, and this is maybe the single most important thing, is focus. When, especially focus on sales. So what Niko is incredible at is honing in on a deal and then working on that deal until it's completed in the best possible way. And this I learned from Niko, that when you want to close a deal, when you really want to complete something, sometimes you have to switch into what we call deal mode, and you do this one thing until it's done. You don't worry about the things that are left and right. You push administrative topics off to the side, and you focus and you get it done. And this is especially applicable in sales.
Thank you both so much.
Actually, what we do to a large degree as an investment fund is actually sales, even though we never call it like that. But I always say, in Aljoscha too, is that it actually is sales. So. Actually, here comes a little small statement. So sales is something that in Germany is kind of frowned upon still. So it's not something that you really want to engage in, or you actually tell others that you're doing. And so when I first started sales for a large IT systems integration and consulting company, I was actually in sales. My uncle told me, I prefer you playing a piano in a brothel in Rome than mentioning that you're actually engaged in sales.
He's wrong.
I would probably not survive in Germany for a day. Thank you both so much. Aljoscha, I know you have to run. Thank you so much for putting up with all my questions today and agreeing on doing this in the first place. It was a real pleasure having you on board. Thank you so much.
Likewise, it was a lot of fun.
Thank you, Diana, and thank you so much for all you're doing for the industry and for media for equity in general. Thank you so much, Diana.
Thank you.
As always, I really appreciate your support. You can find a full video episode on YouTube on the Media for Growth channel, or you can listen to it on Spotify, Google, or Apple Podcast. Make sure you subscribe to the Media for Growth newsletter to get all the insights from our latest shows, including the full interview script. See you next time.